We're joined in the studio by Tony Bell, who's Head of Multi-Asset Fund Management at Vunani Fund Managers. Tony, we've been talking tonight about local equities, foreign equities, the Eurozone and so on. You have a particular investment philosophy, so how are events going to affect your outlook?
Dave, thanks very much for that. The way we see the world is perhaps a little bit different from what one's been seeing and reading in the press. We see the surprise trade in the US as being the economy recovering a little bit more strongly than some of the folk had thought possible towards the end of last year. Certainly towards the end of last year there was extreme pessimism around, with many of the noted commentators being extremely bearish, focusing on double-dip recession possibilities. When we dig a little bit deeper into the data, we find that the US consumer is actually in reasonable shape. The savings rate has stabilized, personal incomes are growing, the number of temporary hirings is improving. The job market, although not in a super state, is improving slowly, and the housing market is starting to thaw. The extremely high levels of foreclosures that were evident towards the end of last year have started to taper off a little bit, and people are starting to get a little bit more confident in their spending ability. The Fed, of course, has helped a huge amount. And really what we're sitting with these days is an unprecedented liquidity environment where the Fed is doing almost everything possible, even beyond the scope of the rule book, to stimulate the economy and to keep the system functioning. So we see a lot of liquidity. Interest rates are obviously extremely cheap. That means companies that are cash flush are taking advantage of the very low interest rate environment to recapitalize. And you're finding a lot of companies investing in technology again. So the general outlook we see for the US is perhaps the surprise trade to the upside. And I think that's why you're seeing the US equity market rebound strongly. Companies that we look at particularly closely, like Apple, like JP Morgan, like Visa, MasterCard, Starbucks, all doing particularly well, with many of those share prices up 30 to 40% in the last few months. Europe is a little bit of a worry. We've got a very big game-changing event in the form of Mr. Draghi and Mr. Monti. The two gentlemen concerned, I think, towards the end of last year, in collaboration with the Fed, did what was necessary. I was becoming increasingly concerned that the previous governor, although very competent at the ECB, was really too preoccupied with the inflation outlook. And in a sense, the ECB was fiddling while Rome was burning. So we see the very significant liquidity push by Mr. Draghi into the European banking system as being a very important development last year, with the removal of, where it removes a lot of the tail risk. If you have a look at the Euribor rate, the European interbank overnight rate, it was starting to freeze up. That rate normally lives at about 2.25%. Towards the end of last year, it was getting to around 1%. So that was a really big worry.
Tony, I'm going to stop you there because
banking crises.
Could I just stop you there? Sorry. Tony, to ask Kevin to come in there. Kevin has a point.
Tony, can we just go back to something that you said earlier on when you were talking about the US surprising to the upside? And in that discussion, you mentioned that you thought companies were spending or starting to spend more on technology. Is that something that you're picking up as an investment theme, or are you trying to factor that into your current portfolio?
Very much so. If you have a look at the age of capital in the States, many of the companies haven't really spent very much on new manufacturing plant equipment technology over the last 3 to 4 years, and the manufacturing cycle is very competitive. A lot of companies in the US are wanting to bring jobs back to the States, try and help alleviate the job problem, and in the process, through the engineering of the Fed, resulting in a slightly weaker dollar, the US companies have been handed a significant advantage. Weaker dollar plus low interest rates plus recapitalization of capital equipment puts them on a very competitive footing vis-a-vis some of their counterparts in China and in Europe. So it's starting to look a lot more positive on that front.
Tony, are there any technology companies you would then look at in South Africa to benefit from a tech cycle generally, or is the market too narrow?
The ones that have been spoken about just prior to the break, I'm very positive on. Pinnacle, I'm very bullish on. I think the company produced an excellent set of results today. The type of companies that I tend to look for in the portfolio are companies that really have a presence in the market they operate in. I look for companies with strong management teams that have pricing power, that don't have a lot of debt on their balance sheet, very cash generative, and have got good return metrics. The return on capital over the cost of capital favors the creation of value for the shareholders. The two in my book at the moment that I think are standout are the two that you spoke about just before the break, EOH and Pinnacle. And then perhaps as an outside bet, it's not very much in favor, but I think one should start paying closer attention to Telkom. There might be something in it a little bit further down the track.
Some people think that there's nothing in Telkom that there wasn't before and there's not going to be now. But there's always value to be had, you know.
At a price.
Yeah. Tony, you've got...
The point...
Carry on.
Sorry, Dave. The point simply to be made on Telkom is that, you know, you were chatting a little bit about the retail stocks earlier. Spar and ShopRite are safe bets, but I don't personally hold any in the portfolios because at about 1.6 times the market, although they are extremely good companies and their prospects look good, you're paying for that in the share price, whereas Telkom, you're really getting a large portion of the business for significantly lower than either its breakup value or its free cash flow valuation. And that at the end of the day, if you cast your mind back to the debate around Old Mutual, I remember post the 2008 crash when Old Mutual traded intraday at R4.50, where the embedded value was north of around $14.50 at that stage. You know, it seemed like the worst possible decision to make, but that's often where the best decisions are made.
Of course, Old Mutual rather different to Telkom because there's so much regulatory issues around Telkom. It all depends what call you make on what they're going to do with the last mile of fibre optic cable and things like that, where a single decision can affect investment prospects hugely.
Yes, what intrigues me there is that, you know, the talks with the Koreans have been reinitiated. You've got a significant customer base. I understand clearly all the risks involved, but to a certain extent those risks are priced in, or to a very large extent those risks are priced in, and the share's trading at about half of what its free cash flow valuation suggests it should be trading. So in essence the margin of safety is extremely high, and it won't take much, I think, you know, change in management structure in the business with a little bit of international input to start to get some action. I'm not saying it's a dead cert, but certainly it is interesting at this price.
Tony, can we switch to some of your exposure in the resource space? You seem to have quite a lot of active bets on some of the big resource companies, particularly BHP. Is that something that feeds off your view on the United States, and I assume a reasonable view on the global economy? Are you fairly positive on commodities generally?
Dave, that's quite correct. If you have a look at last year, my investment hypothesis for this year is essentially that with the above average growth expectations in the States, we could find ourselves running into a little bit of a headwind as inflationary pressures start to build up. Ben Bernanke, the chairman of the Federal Reserve, did indicate in his testimony or his speech last night that, or 2 nights ago, sorry, that inflationary pressures would rise in the short term. We don't see any immediate risk of runaway inflation, but if you consider that the Fed fund rate is sitting at 0.25 and core inflation is currently sitting in excess of 2 with headline inflation just under 4, it's something that we mustn't lose sight of as the global economy reflates itself, and that's as true in China as it is in the States. So we're not seeing runaway commodity prices. The thing that I think will dampen commodity prices in the near term is we're looking at a stronger dollar, driven really by investment opportunities in the States and a flow of dollars back into the States. So I'm not wildly bullish on the commodity prices per se, but what I do find when I do the valuation of the commodity companies, that there's quite a high margin of safety in both Billiton and Anglo's. Exxaro, which is one of my top picks, is a slightly different case. The quest for rare earth minerals and some of the more difficult to obtain minerals like zircon and titanium, which is part of the Exxaro portfolio, creates a premium value for Exxaro, as opposed to perhaps Kumba, which I think is getting quite full, with a lot of iron ore supply starting to come onto the market next year. That's one I'd be a bit more cautious on. So it's very much a stock. Anglos and Billiton, more strong balance sheets, lots of cash, a high margin of safety, where Exxaro and Kumba present different investment theses.
Tony, just to wrap up, to get back to the consumers, you've got Woolies, you've got Truworths, you've got SAB Miller. That's not obviously just local consumers. Some thoughts there
Sure.
on the consumer aspects? You did say earlier some of them you don't want to because the value is already in the share.
Yeah, I agree with you. And I was listening when I was sitting waiting to come on. I was listening to the previous commentators. Woolworths, I think, is doing a particularly good job of innovating. The mix of store utilization space is improving their margins quite nicely. We saw that in the recent results. And it really talks to the type of company that I'm looking to invest in, where you have companies like Woolworths that don't present great value at the present, but the strategy is very sound. Pick n Pay, I think, with respect to management, they've lost their way a little bit, and they've been unseated by the likes of Spar and ShopRite on the one end of the retail spectrum, and Woolworths on the other end of the spectrum. Truworths, I must declare my bias. I'm slightly married to the stock. I think it's an exceptionally good retailer. It's pretty hard to sell something that continues just to do well. It's a little bit like betting against Johan Rupert. Michael Marks has done a fantastic job, and I think that's a stock that you just keep and you're patient on the price, because the value is a little thin at the moment.